Hey Bowtie Nation, Joseph Hogue here with something of a public service announcement for all the index fund investors out there. You know, I love index funds for that core part of our portfolio, a way to get that stress-free market returns to reach your goals. But the stock market flipped last year and created two giant problems for index investors. Now there are solutions here, things you can do right now to keep investing in index funds, enjoying that set it and forget it strategy. But I also want you to understand what's going on so you can fix it again when it happens later. So I'm going to start with what happened and then show you the two solutions along with some index funds to buy right now. We see what happened in the 23% return on stocks in the S&P 500 last year. It wasn't all that it seemed. In fact, just 7 stocks in that index, the Magnificent 7, were most of that market's gain. The 7 largest companies returned an average 76% last year, with the other 493 companies in the stock market index posting just a 12% return. That means funds based on the S&P 500 index, like the SPDR S&P 500 ETF, that ticker SPY with more than $400 billion in investor money, it's not really a fund at all, but a bet on just 7 stocks. You see here in the holdings of that market index, the top 7 companies account for 28% of the index weight. That is the highest exposure since at least 1980 and could be the highest ever, well above the 15% weight those top 7 companies have typically held. Now, these tech giants, Apple, Amazon, Tesla, Nvidia, Google, Alphabet, and Meta are all good companies, and there's nothing wrong with owning these shares, but if you want that true broad-based index fund investing for just less risk, these 7 stocks have created a $12 trillion problem. $12 trillion. That is the combined market cap of this Magnificent 7 stocks. And you can see here, the problem is getting expensive for investors. Those 7 tech giants trade at 33 times on a price-to-earnings basis. That's 50% more than the average 21 times PE for the rest of the market. And the problem is these 7 stocks aren't likely to produce that 76% return again this year, and it's going to make those popular index funds a losing bet. It's not just the US index funds with that concentration problem either. Those top 7 stocks make up 17% of the world stock market index, more than all the stocks in the UK, China, France, and Japan combined. So that also means index funds like the Vanguard Total World ETF, the VT, aren't going to save you from this problem. Now, beyond that problem of overexposure in the popular index funds, the outperformance of stocks versus the asset classes last year could mean you're taking more risks than you should. That 23% run by stocks compares to just 2.5% return in bonds, here in purple on this chart, and a 0.5% return in real estate stocks. So for example, if you started the year at your target percentages of 65% in stocks, 15% in bonds, and then maybe 20% in real estate, you'd now be well off that, almost 70% in stocks, 13% in bonds, and 17% in real estate. And that in itself might not seem like much, but moving off your target portfolio percentages can set you up for bigger losses if stocks do eventually come down. Nation, you cannot ignore these problems if you're an index fund investor. If you have ETFs or index funds in your portfolio, ones that cover that broad market like the Vanguard 500 Index Fund, maybe the VOO, the Vanguard Total Stock Market Index, the VTI, or the SPDR S&P 500 ETF, that SPY, you need to know the risk in your portfolio. Fortunately, there is an easy solution to this, and you're going to find it in 3 of my favorite index funds I'll show you later. But first, making rebalancing your portfolio one of the solutions easy is today's sponsor, Passive, a portfolio tracking and monitoring platform that can show you all your investments in one place. Passive connects directly with your brokerage accounts. Here you can see I've connected accounts from Robinhood and E-Trade, including multiple accounts in each. You'll get detailed reporting on everything from dividends to how much you have in the different assets and stocks. Like the name implies, Passive is a tool for investors that want to take the guesswork out of investing and, more importantly, want to stick with a plan. I'll show you why it's so important later, but Passive is going to be a great tool for rebalancing your portfolio after big stock market gains. With Passive, you'll be able to set how much you want in each stock or those broader asset ETFs. You'll also set your percentage for each portfolio. Here, I've taken one of my retirement accounts and set limits for how much I want in each stock. Passive is going to tell you when your portfolio has breached those limits and the trades that'll put it back in place. You'll even get email alerts when the portfolio has drifted from your percentages. I'm going to detail why rebalancing is so important, even for index fund investors later, but for now, look for that link to Passive in the description below and check it out. The free plan is going to get you started with automated tracking, dividend notifications, and to help you keep track of multiple portfolios in one. Or try the Elite plan with a 100% money-back guarantee. Back to those solutions for index fund investors. And first is the Invesco S&P 500 Equal Weight ETF, that ticker RSP, which completely fixes that problem of concentration. Here, instead of weighting each stock by its company size, by that market cap, the RSP holds an equal amount in each stock in the S&P 500. spreading the exposure out evenly across the index, so you keep that index exposure to the largest U.S. companies, but across all of them. That equal weighting also clears up some of that sector-level problem in the index, dropping tech stocks from 27% of the group down to 13%, and communication services down from 9% to just under 4%, while other sectors get a little bit more exposure. So this fund is going to tilt your exposure towards those smaller companies since they have higher weight than in that regular S&P 500 index. But even the smallest company, Fox Corporation, is still a $13.8 billion giant. So this is still very much a large cap fund. Even better, because those big tech companies that are overweighted in the traditional S&P 500 ETFs are lousy for dividends, the RSP ETF pays a higher yield at 1.7% versus just the 1.4% average return on the market index. It's a great way to keep that index fund safety and get market returns, but without putting your portfolio at risk to just a handful of stocks. Another way you can fix this index fund problem is through investing in a fund that has a different focus, like the Wisdom Tree US High Dividend Fund, ticker DHS. I highlighted the DHS in a recent video for its high 4.3% dividend yield, nearly 3 times the yield you get on the overall market, but there is another reason to own it here. The fund holds shares of 384 large U.S. companies paying a higher than average dividend yield, and you see here in the top 10 some of our favorite stocks here on the channel. We see AbbVie with its 3.8% yield, a Chevron paying a 4.2% dividend. These are all very large cap, mega cap companies, so this could be a replacement for that S&P 500 index in your portfolio. Looking deeper into the sector exposure for the fund, as is usual with most high dividend stock funds, we do see that the DHS is more heavily invested in stocks of financials, energy, and utility companies paying out those higher dividend yields. So you might not get the same price growth as you get from that S&P 500 index, which has nearly a third of the index in faster growing tech stocks, but you will get that cash flow kicker to make up for it. This could also be a great addition to a portfolio with an S&P 500 index fund, or another where you have a high concentration of tech stocks. By adding that DHS, you're spreading your risk out into those other sectors like energy, financials, and utility, taking some of the risk out of tech. Now, another good solution is spreading your risk into smaller companies. The Vanguard Small Cap Index Fund, ticker VB. This fund holds shares of over 1,400 companies with a median market size of $6 billion, which is still pretty darn big, but much smaller than the mega-size $195 billion companies in the S&P 500 index. Stocks here are also much cheaper at just 14.6 times on that price-to-earnings basis versus the 23x multiple on stocks in the S&P 500 index. So you've got these smaller companies not only have more room to grow for those higher returns, but also give you a solid value tilt to your portfolio. Again, you're adding some sector diversification to your portfolio, so you don't have half of it in growth stocks like tech or communication services. You pay a low 0.05% fee to hold the fund and again collect a 1.7% dividend, higher than the 1.4% average dividend yield on the S&P index. In the VB, you're still going to get a solid exposure to those growth stocks like tech in that small cap index fund where the sector is almost 13%, along with consumer discretionary at 16%, but overall, it is more diversified across those sectors than the larger index. And best of all here, with those 1,400 plus stocks, you don't have to worry about anyone destroying the fund like you would with the crash of the Magnificent Seven in the S&P. Here, no stock is more than 0.4% of the fund, so it's much better spread out across stocks. Now, those index funds are going to help you solve that problem of concentration in the stock market, but you also likely need to rebalance the amount of money you have in those stocks and your other assets. I showed you last week how to determine how much of your portfolio should be in stocks, bonds, and real estate based on the return you need to reach your goals. I'll link to that video in the description below. Make sure you check that out. Again though, because stocks have outrun bonds and real estate on returns since the bear market bottom, your portfolio is likely way more overexposed to stocks. I know, folks, it's easy to just sit there and say, well, stocks are the better long-term return anyway, so what's wrong with being 100% in stocks and just ignoring this rebalancing thing? Well, ask anybody that saw their tech stocks crushed for more than 2 years as the Nasdaq plunged 82% in the dot-com bust, or saw half of their money evaporate when stocks crashed again in the Great Recession. Folks, most investors just don't have the time or the patience to sit and wait for stocks to rebound when that happens. They panic sell at a loss and have to say goodbye to their dreams. So then rebalancing after a great year like we just had in stocks, not selling all your stocks, but just enough to make sure you still have those target percentages in bonds and real estate as well, that is going to protect you from that stock market crash that eventually will come along and keep you on track for your goals. Make tracking and rebalancing your portfolio easy with passive and the link below, or click on the video to the right for a stress-free passive investing strategy that will reach your goals. See exactly what return you need and how to get there. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.